Okay, hey everybody, Dan Fitzpatrick here, stockmarketmentor.com. And I want to show you something that we did at Option Market Mentor today, late, kind of mid-afternoon, excuse me, a couple hours before the market closed. As you should know anyway, Microsoft reported earnings after the bell. Now, in the options market, options traders always game this type thing. They're deciding how much the stock's going to go up, how much the stock could go down, stuff like that. And the idea is that buyers want to buy options that they think are going to make money if the stock moves in their direction. And the issue with that is the stock can move in your direction, but if you paid too much for the option, then you're still going to lose money. If you paid a little bit for the option, then you can make a lot of money. In other words, the stock doesn't just need to move in your direction, but it needs to move enough in your direction to have you make money. And if you're trading short-term options, that can be a little bit of a challenge. It's, in my mind, the vast majority of times, not all the time by any means, the vast majority of times, the sucker's bet is to buy calls or puts because they are priced to make you lose money. And this is why. You have to look at the other side of the trade. Sellers are essentially like insurance companies. They kind of use the option equivalent of actuarial tables. They look at probabilities and they determine how much the stock is likely to move based on the pricing in the options market. And this is how it works. Let's say somebody thinks that Microsoft is going to let's say somebody thinks it's going to trade at, like, let's say it closed at 350. So they think that it's going to trade either $5 up or down. That's the maximum. That's the maximum thing. That's the maximum move that they think it's going to trade. So they will sell what's called a straddle, where they will sell a $350, that's at the money. They'll say a $350 call and a $350 put. And they need to get at least $5 for that. Because if they get less than that, then they're putting themselves at risk to where if they only got, say, $4 for it or something for the combined straddle, call and put, then what happens if the stock moves up to $350? They're screwed. They're losing money. And so what they will do is they'll look at what the price of the straddle is, and then they will, quote, bet accordingly. And they may do that by, again, like selling an at the money straddle, but they also might look at the implied moves and say, well, I think I'm going to trade out of the money. I think if the implied move is going to be $5 one way or another, then I want to go ahead and sell a call option and a put option that is a little bit outside of that $5 anticipated range. Well, that's what we did. I just used $5 because it's easy math, but that's what we did. Was I looked at the options market, and it was actually a pretty easy. It was actually a pretty easy look. I'm just looking at it now. The implied move on these options was, I'll show you, it's real easy to see. The implied move on these options right here is the front month options. They expire on Friday, this Friday. And the implied move was, we'll call it $20. So that's what the options market was pricing, the maximum move that they thought the trade could make. And you'll notice here, 78% implied volatility. These were expensive options. So you want to be selling those. So $19, we'll call it a $20 implied move. The market thinks this thing can move up to 370 or down to 330 as a maximum move between now and, or at least it would close this Friday. So what did I do? Well, I got a little bit of a wussy part of me up above here. And rather than go down to, and again, it was at 350, rather than go down and sell the 370 calls, I went up further and sold the 375s. And then on the downside, I did like that $20 difference. So I sold the 332.50 puts. And so based on the premium that we got, and these are $10 spreads on each side, sell the 375, buy the 385, sell the 332, buy the 327.50. And so we're taking a $10 risk on each side. Excuse me. Yeah, $10 risk maximum. Hope you can understand this. And we're only getting $250. So we're risking 1,000 and we're only taking in $250. So our net risk is $750. Not a good risk reward, not at all. But when you factor in the probabilities, I like it. And so this is a trade that we took. And now as I'm looking at this, so we take in $250 per contract on this. We're going to make a gang of money here tomorrow. And do you know what we have to do? Nothing really. Just hold the position until Friday, or just hold it throughout the day. Maybe on Thursday, when the options bleed enough of a value to where they're just about worthless, then you go ahead and spend a couple bucks in commission and close the trade. So this is the type of earnings trade that I like to make because I'm with the house. I am selling probabilities as opposed to buying probabilities and hoping that they're wrong. So you may want to give that a try. And by the way, this is one of the trades that we do a lot at Option Market Mentor. So if you're not a member, you may want to check that out. Your choice, your trade. And that's the end of that.